Are you into crypto but tired of losing money with random strategies that don't work? Then this video is for you. Understanding the crypto market basics. To succeed in trading, you first need to understand the environment you're stepping into. And in crypto, that means understanding volatility. The crypto market is extremely volatile. Prices can rise or drop within seconds. That's both a danger and an opportunity. Key concepts. Volatility equals risk plus opportunity. The world of crypto is full of surprises. A coin can hit new highs one day and crash the next. This scary-sounding volatility can actually become an opportunity for profit, if you understand the basics. This guide breaks down how crypto price swings work, and gives you practical strategies for using them to your advantage, even as a beginner. What is volatility? Volatility means how fast and how much prices change. It's what makes a token jump or drop by 10% or more in just a few hours, sometimes even minutes. Volatility in action. A real example. Let's look at Bitcoin in 2021. January started around $30,000. April jumped to an all-time high of $63,000. July dropped back down to $30,000. November shot up again to over $68,000. This roller coaster shows how volatility can create big opportunities for traders. Whether you're buying the dip, riding the wave, or selling the peak. Why is crypto so volatile? Several reasons. Market sentiment. People's emotions move the market. A single tweet, new regulation, or tech news can trigger big spikes or crashes. Limited supply. Many crypto assets have a fixed supply. With rising demand and limited availability, prices move fast. Young market. The crypto market is still developing. Its rapid changes and unpredictability increase volatility. Global 24/7 success. Crypto is always on. Trading never stops. That means more opportunities for sudden price swings. So, is volatility always bad? Not really. For traders, volatility equals opportunity. Especially for beginners, it can mean frequent chances to profit, low barrier to entry, fast learning curve. In short, volatility isn't just risk, it's also the fuel for growth and learning in the crypto space. Liquidity equals easier to enter and exit trades. Let's talk about liquidity. In crypto, liquidity means how easily you can turn a coin into cash, or another crypto, without changing its price too much. High liquidity is great because it makes markets more stable. It allows for fast, fair trades. It lowers the risk of manipulation. Just like in traditional markets, liquidity is a good sign of a healthy crypto environment. The more liquidity, the stronger and safer the market is for investors and traders. Volume equals strength of a trend. Now, let's talk about volume, one of the most powerful tools in trading. Volume shows how strong a price trend is. Here's how to read it. 1. Rising volume plus rising price. A strong bullish trend. Lots of buyers entering the market. The price is likely to keep going up. 2. Rising volume plus falling price. A solid bearish trend. Strong selling pressure. The price may keep falling. 3. Falling volume plus price moving up or down. A weakening trend. Low volume on a price rise. Buyers aren't confident. Low volume on a drop. Sellers are losing steam. This might mean a trend reversal is coming. Think of volume as the fuel that powers price movements. The more volume, the more reliable the trend. And that helps you know when to enter and when to exit. Before we continue, I just want to remind you of something important. I'm not a financial expert. Everything I share here is based on life experience and constant research. Always do your own research and consult professionals before making financial decisions. A strategy isn't magic, it's a system. A solid crypto trading strategy should include entry and exit points in crypto trading. What are they? Entry point, the price at which you buy an asset. Exit point, the price at which you sell it. Choosing the right entry and exit points is essential to make a profit and reduce risk in the highly volatile crypto market. How to define entry and exit points. 1. Technical analysis. This involves studying charts and indicators to predict price movements. Support, resistance. Buy near support, the floor. Sell at resistance, the ceiling. Moving averages. Golden cross. Short-term MA crosses above long-term MA. Buy signal. Death cross. Short-term MA crosses below long-term MA. Sell signal. 2. Fundamental analysis. Evaluate things like the project's technology, the team, and market demand, especially useful for long-term decisions. 3. Risk management. Must have. Use stop loss to limit your losses. Set take profit levels to lock in your gains. Never risk more than you can afford to lose. Risk management in crypto. Essential strategies. The crypto market is highly volatile, and about 70% of traders lose money. If you want to be among the 30% who profit, risk management is key. Here's how. 1. Diversification. Don't put all your eggs in one basket. Invest in different cryptocurrencies. Include traditional assets like stocks, bonds, or commodities for balance. Platforms like Trakx offer crypto index funds, CTIs, with automatic rebalancing to help with diversification. 2. Stop loss. Protect yourself from big drops. Set stop loss orders to sell automatically if the price drops below your acceptable limit. Adjust your stop loss based on technical analysis, support, resistance levels, the asset's volatility. Avoid setting stops too tight, premature exits, or too wide, huge losses. 3. Use safe and regulated platforms. Choose exchanges that are regulated and have strong security. Use protection measures like strong passwords, two-factor authentication, 2FA, hardware wallets for long-term storage. Hacks and scams are common. Security should never be an afterthought. 4. Technical plus fundamental analysis. Make informed decisions. Technical analysis. Study charts, moving averages, and indicators like RSI or Bollinger Bands. Identify support, resistance levels and patterns, triangles, head and shoulders. Great for timing your trades. Fundamental analysis. Evaluate the project's tech and innovation, the team and market adoption, regulatory landscape and macroeconomic factors. Ideal for long-term investment decisions. 5. Control greed and stay disciplined. Small, consistent profits are better than chasing quick riches. Compound interest turns small gains into big returns over time. Mistakes will happen. Learn from them and improve your strategy. Final thoughts on risk management. Managing risk in crypto means smart diversification, well-calibrated stop losses, safe platforms, combining technical plus fundamental analysis, emotional discipline. With these strategies, you reduce your chances of loss and increase your potential to profit. Consistency. Maintaining a consistent strategy is crucial in trading, but the market's volatility can tempt you to abandon your plan. That's where artificial intelligence becomes a powerful ally. Why is consistency so important? Well-tested strategies usually perform better in the long run. Emotional or impulsive changes increase risks. Confidence in your plan prevents panic-based decisions. How AI helps you stay consistent. Real-time data analysis. AI can process millions of data points, price, volume, news, in seconds. It spots patterns that human eyes might miss. Objective confirmation of your strategy. If the AI model confirms your strategy still works, you won't make unnecessary changes. It reduces overreaction to short-term moves. Ongoing market monitoring. AI adjusts parameters automatically when conditions change, without altering your main strategy. For example, if AI confirms a trend is still valid, you keep your position confidently. The result? Less emotion, more discipline. AI acts like a rational co-pilot, helping traders avoid impulsive decisions. Stay true to the original plan. Execute better without losing consistency. Conclusion: in trading, consistency plus data equals advantage. AI doesn't replace the trader. It reinforces discipline and supports smarter decisions in a fast-moving market. Essential guide to day trading crypto: 10 strategies to maximize profits. Crypto day trading is attracting more and more investors thanks to the market's high volatility, which offers strong profit potential. But to succeed, you need effective strategies and disciplined risk management. This guide outlines 10 proven techniques to help both beginner and experienced traders improve their performance. 1. Understand market trends. Recognizing whether the market is trending up or down is key for making smart decisions. Tools like moving averages and chart patterns, e.g., head and shoulders, double tops, help predict price direction. Key actions. Check charts daily. Use trend indicators, for example, MECT, Ichimoku Cloud. Stay updated with news that may affect the market. 2. Use technical analysis. Studying historical price data reveals patterns and ideal entry, exit points. Helpful tools. Candlesticks. Understand market sentiment. RSI and Fibonacci. Measure momentum and find reversal levels. Volume. Confirm the strength of a trend. 3. Set entry and exit points. Planning your trades reduces emotional decision-making. How to do it? Set stop loss to limit potential losses. Set take profit based on risk, reward ratio, for example, 1:3. Review and adjust your strategy after each trade. 4. Diversify your portfolio. Spread your investments across different cryptocurrencies, for example, Bitcoin, Ethereum, DeFi tokens, to reduce risk. Tips. Include assets from various sectors, NFTs, metaverse, etc. Rebalance your portfolio regularly. 5. Manage risk strictly. Protect your capital with clear rules. Risk only 1% of your capital per trade. Avoid excessive leverage. Use automated protections, e.g., trailing stop. 6. Follow market news. Regulation updates, tech launches, and social media sentiment can heavily impact prices. Recommended sources: CoinDesk, Cointelegraph, Twitter accounts of reliable experts. 7. Use trading bots. Automate your strategies with trusted bots, e.g., 3 Hasonline, but always test them in demo mode first. 8. Prioritize liquid assets. Focus on high-volume coins, like BTC and ETH, for smaller spreads and faster order execution. 9. Stay disciplined and patient. Stick to your trading plan. Don't fall for FOMO, fear of missing out. Review your past trades to improve decision-making. Conclusion: mastering these strategies, from technical analysis to risk management, is essential for navigating the volatile crypto market. When combined with discipline and ongoing learning, they increase your chances of long-term success. Bonus: let's talk about one beginner-friendly strategy. Swing trading. This method involves holding a crypto asset for a few days or weeks, aiming to profit from short to medium-term price movements. How to do it: 1. Identify a strong market trend, bullish or bearish. 2. Confirm your entry using indicators like RSI, MECT, or moving averages. 3. Set a clear take profit and stop loss. 4. Stick to your plan. Emotions are your biggest enemy. Benefits of swing trading: no need to watch charts all day. Less emotional pressure. Works in both bull and bear markets. Please don't forget to hit the like button, subscribe to the channel, and share this with someone who wants to improve their crypto trading game. Drop your questions in the comments below. I'd love to hear from you. Investing in cryptocurrencies. How to manage risk the smart way. The crypto market offers huge profit potential, but it also comes with high risk. Without a solid risk management strategy, a market crash could wipe out your entire investment. To help you invest more safely, here are 5 essential principles you should follow. 1. Never invest all your money, only use idle capital. Golden rule: only invest money you can afford to lose without harming your personal finances. Avoid debt. Don't borrow money or use funds meant for essential expenses to trade or invest. Diversify. Spread your capital across different assets instead of betting everything on one coin. 2. Set stop loss and take profit for every trade. Stop loss automatically limits your losses when the price drops to a certain level. Take profit locks in your gains by selling when the price hits your profit target. These tools help you balance risk and reward, giving you more confidence when trading in a volatile market. 3. Even the best strategy won't work without risk control. Rules to follow: never risk more than 1% of your capital on a single trade. Always use stop-loss orders to prevent large losses. Don't chase losses. Revenge trading is a trap that leads to even more mistakes. 4. Trading psychology is just as important as strategy. Stay calm under pressure. Avoid emotional decisions. Stick to your plan, especially after a loss. 5. Learn and adapt constantly. Study your past trades, both wins and losses. Keep improving your strategy. Follow market news and trends to make informed decisions. 7 common crypto investing mistakes and how to avoid them. 1. Neglecting research. Each cryptocurrency has its own technology and use case, e.g., Bitcoin not equal Ethereum. Market prices are influenced by things like regulation, economic trends, and global news. Solution: always study a project before investing and stay updated on industry news. 2. Investing more than you can afford to lose. Crypto is extremely volatile. Even a tweet can cause major price swings. Solution: only invest money that won't affect your financial stability if lost. 3. Lack of diversification. Putting all your money into one coin increases your risk significantly. Solution: spread your investments across different cryptocurrencies, stablecoins, and even other asset types. 4. Ignoring security. Crypto assets are frequent targets for hackers and scams. Solution: use strong passwords, enable 2FA, two-factor authentication, and store assets in hardware wallets for better protection. 5. Acting on emotions. Fear and greed often lead to impulsive decisions, like panic selling or holding too long. Solution: follow a solid trading plan with clear rules for entry and exit. 6. Not using stop loss and take profit orders. A stop loss limits your downside. A take profit locks in your gains. Solution: set automated orders to protect your trades from emotional decisions and constant monitoring. 7. Falling for scams or trying to recover losses quickly. Pump and dump schemes and revenge trading after losses are common traps. Solution: be skeptical of miracle opportunities. Stick to your plan and stay disciplined. Don't forget, you can check the video description for some helpful resources. To sum it up, understand the market. Use a strategy like swing trading. Manage risk like a pro. Stay calm and never stop learning. Trading isn't about getting rich overnight. It's about building wealth over time. So if you found this helpful, please like, subscribe, and share with a friend. Leave a comment with your favorite part or your biggest takeaway. See you in the next video. Keep learning and keep growing.